Hello investors, and this is Sal giving you another update here on a weekend, Saturday the 13th of March. And we just got the chart of the day thanks to chartoftheday.com, and I just wanted to point it out and share it with everybody who may not get this weekly email from chartoftheday.com. Thank you to them again. This is a PE, price to earnings ratio, on the S&P 500. So it is nice to check every once in a while on previous historical data, a little bit of history on the weekends, because that's what the weekends are great for, to look back and see what's reality and what isn't. And I just want to point out, this is 1935 to as current as it can be. What I want to show is this PE normal range used to be 20 price to earnings was somewhat expensive, and then 7 to high 5 or 6 price to earning was ridiculous value. So if you just look at this range, you should consider lightening up and raising cash in the higher levels, and definitely implementing some kind of dollar cost averaging program into this lower range. Now, post the late 80s, or actually the early late 80s, if I had another chart I could show you the high interest rates, but high interest rates, high discount rates meant lower value, actually more value, lower PEs. Let me rephrase that. When interest rates are high, people want more value, more rent on capital, more rent on investment, more rent on debt that they're investing in. So interest rates were very high and then they went down. So then the opposite happened. When interest rates are high, low PEs, you can buy a lot of stuff for high value. Now that interest rates have been low, everything gets relatively expensive because we're taking lower discount rates. And you can see that by this new range as it's rising. We're willing to take more and more risk because interest rates are so low, and capital is getting invested and is in demand, but rates are low. And government debt is 4 and 2%. And this is why this is trending upward, up as high as 40. And this spike to 150, don't think that people are paying that much for earnings. It's just that the earnings fell off so fast that the prices weren't reflecting that. So very interesting to see how sharply this spiked up, which means earnings crashed and then came back down. So value is reflecting, or prices are reflecting a more normal range. Stocks with a 10 PE, actually the whole S&P at a 10 PE is not ridiculous. That's what this range the previous range suggests. But the crack of this previous rise is now showing, hey, this volatility is saying change is coming, or change is here. So maybe we just have to recognize the change. So I just wanted to point that out. Don't be too worried about PEs, because it used to be normal to have lower PEs because rates were higher. Rates are low, so if that continues for the next 10 years, then yeah, we'll have some range above this 20 PE, and stocks will be relatively expensive over 100 years. But if rates go to a more normal meaning over the past 50, 60, 70, 80 years, then we could have different PEs than what we're currently taking. So just be very selective of value. That's all this would say, and it's a nice little conversation piece on a weekend. So I hope you're enjoying yours, and get your rest for a new Monday coming on. Take care.